Welcome back. It's day 4 of the boot camp. I hope most of you guys are still watching. Let's get right into it. Let me just clear my charts for you guys. Okay, so today we are going to be going over liquidity. What is liquidity? What is liquidity sweeps? How do we use them? What do they mean? Great, so we have our two chart examples right here. And what is liquidity? Liquidity is basically money that is in the market where people have entered or bought and they have what's called like their stop losses, right? Let's say, for example, someone is in a long right here and they have their stop right here and they're longing to who knows what, okay? They have their stop loss here, their money is here. Let's say they're risking $1,000. Their liquidity is basically $1,000 of liquidity is resting here. The market can't move without liquidity, right? Someone has to lose money in order for someone else to make money. So someone has to lose, get stopped out in order for someone else to take profit and make money. This is why there is something called liquidity. Market likes to take out liquidity so that it has money to move the market to where it wants to move. Okay, so where do liquidity rests and how do we use them? So liquidity usually rests at highs or lows. So there could be liquidity right here, like I said. There could be liquidity right here. 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 So liquidity could be at any highs or lows, okay? Now, the difference between certain types of liquidities are based on where the highs and lows are placed. As you can see here, we basically have a big range right here. We have this high and we have this low, and it's like the peak of the movement, right? Like these are the bottom of the bottom, and these are the highest of the highs. Inside of these highs of the highs and bottoms of the lows, there's going to be lows and highs, right? Market doesn't just move up and down. It has up and down, up and down, up and down. It has little movements along the way. What we call these little movements are inside of a big range. It's called engineered liquidity. These are low, minor buy side liquidity, sell side liquidity, okay? Buy side liquidity is the highs. Why? Because these are pretty much where people want to, sell, and these are people where people want to buy. So when people take out these buyers, it's called buy side liquidity because their stops are called buy stops. Sellers or buyers who are in a buy have their stops called sell stops, which is why these are called sell side liquidity. Inside of these liquidities, these are all called engineer liquidities. Okay. Why are these called engineer liquidities? It's because they're super low. They don't have a lot of power. They don't have enough liquidity. Big buyers buy down here. So let's say we have $1,000,000 up here and $1,000,000 down here because you want to buy at the lowest. You don't want to buy in the middle. So people who buy in the middle won't be spending $1,000,000. They'll be spending, let's say, 200K, 100K, 50K. And the market understands that it needs liquidity to make big movements. Well, these 50Ks and 100Ks are not enough to make the movement, which is why price continues lower and breaks past them. So this is why it's called engineer liquidity, because in the end, price is going to come back down and run through them, okay? Price is going to come back down here, and let's take, for example, right here, we have the big position, $1 billion liquidity right here. We see price comes back down, takes out all the $1 billion of dollars that are in buys and takes them out. So there's now, let's say, $1 billion floating in the market. Now, the market's going to take that $1 billion and use that to pump it up into the right direction that it wants to go to. So it's going to continue higher, right? Because it needs liquidity to move. This is what we call a sell side liquidity sweep, okay? Because all the people who are in sell and buys have their sell stops here at the low. They get swept out, lose their money, and price continues higher. Here is what we call a buy side liquidity sweep, because people who are in sells have their buy stops at this high. They get swept out, right? They get swept out and price tends to head lower again. Okay? These is buy side liquidity and sell side liquidity. Now, how can we use this to pair onto the chart? When we're seeing all these liquidities, we want to see when price comes up, we want to see if price kind of reacts and comes back into the range. If price comes back into the range and continues lower, that's what we call a sweep. If price continues higher and higher, those are not a sweep. They're just being stopped and price just continues higher. There's most likely another form of liquidity that it needs. Like let's say there's another high right here that it needs, and that's gonna react to it and head lower. Okay, so how do we figure out and use this on the chart? Let's take, for example, the 15, or let's do the 5-minute today. Okay, we have the 5-minute today, and we have, let's just mark out all the liquidities. Okay, let's take this for example. From this range to this range. Okay, so from this range to this range, we have our highest high right here, and our highest high right here, and we all have our lows right here, the lows right here. I'm just marking out all the highs that are present. Okay, all of these highs and lows. Okay, clearly you can see there's a lot of highs and lows because that's how the market moves. Okay, now we see here, let's take for example, we're from here to here. We have our lowest low of the range and we have our highest high of the range. Okay, and pretty much we see that all of these are what we call engineered liquidity. Okay, these are low liquidity. There's probably only like a few thousand, $100, and here has, let's say, 100 million. Okay, we want to see price come down, right? And we see that we have a little sweep of this liquidity right here, stopping the people that are out in buys. Okay, so they get stopped out. There's money in the markets. Now we want to see the market come back into the range. As we see here, market uses that liquidity and uses it to push upwards. And then as we can see here, all of these people that are in sells have their buy stops liquidated. And we can see here price comes in, taps, and we get back into the range and price heads lower. Again, the price moves again. We see here price does not take out the liquidity right here and continue higher, which means this right here is engineered liquidity waiting to be taken out in the future. All of this are engineered sell side liquidity, engineered sell side liquidity, engineered sell side liquidity, until we get this high right here where we kind of see price coming back down and we see it take out all of these engineered liquidity until we hit the big bottom, which is right here, right? We see here price sweeps out this liquidity that made this huge range, right? This range is right here from the high to the low. And we see here price comes back into this low of the lowest, sweeps out the people that are in buys, taking out their sell stops, and we get back into the range and we see we head higher. Okay. This is how we figure out how the market likes to move. The market moves 3 ways. It likes to balance ranges, right? Coming back into the 50% and tapping, fair value gaps or things like that, gaps to fill, or it targets liquidity. Okay, that's how the market moves. There is always a mission in the market. Okay, let's take another look at some examples. Let's take a look at right here, which is a great example at this. Let's say we take this example. We see here that there's liquidity here. There's a bunch of liquidity, buy side liquidity right here, buy side liquidity, all of these buy side liquidities. We see, again, this is how market moves 3 ways. We see that market comes back down to balance out this range, right? Because let's say if market keeps continuing higher like this, it just doesn't make sense because it has to it needs sellers to kind of accommodate the buying, right? An auction always needs 2 sides, right? So we come back, we see price balances out the range here and we head a little higher. and all of these engineered buy side liquidity right here gets taken out. This right here isn't a liquidity sweep because we see price comes up and price doesn't come back into the range. If price was to come back into the range and start going back into a downtrend, we can see price start to head lower and maybe target the sell side liquidity right here. But because price ends up breaking past it and start respecting it again in a uptrend, this becomes a higher time frame change in state of delivery, right? Let's say we go on the 1 hour. On the 1 hour, what did we learn about breakup structures and change in state of delivery? It's when it breaks past a higher high and creates a higher high and lower low. Right here, as you can see on the 1 hour, not really good with drawing, but you get the point. This breaks past is a break of structure, and we can see price heads higher. So again, price is always fractal, okay? Now, how can we use this and pair it with the fair value gap that we learned from the previous video? Let's take, for example, again this. We see here that price comes down or comes up and takes out this liquidity right here, okay? Takes out this liquidity, comes down, and we start forming a downtrend, right? We're heading lower. And we see here we have a fair value gap right here, and we have a fair value gap right here, okay? We also have an inverse fair value gap right here. Now we see price taps into this fair value gap right here. We know price swept liquidity, so the market is using that liquidity to move it lower, and we have this fair value gap as our entry. And on this candle, you could have clicked sell and held it to this sell side liquidity right here, right? So let's say you sold here and you got out of the trade at this liquidity, sell side liquidity right here. And there we have it. You would have won your trade right here, okay? Again, you could have done the same thing right here. We see price comes a little lower. We sweep out this liquidity. We come back into the range. We inverse this fair value gap, as you guys have learned, which flips it. We could have entered our long right here, clicked buy, and we could have just targeted an engineered liquidity. You can use engineered liquidity as a target, right? So you would have came in, you would have bought right here, and you could have sold right here. What else could you have done? Put your stops below this liquidity because we already took out liquidity and market has enough liquidity to move it. And you could have bought right here and you could have held all the way to the highest of the high range, right? Usually if we take out the lowest of the lows and it respects it back into the range, you're expecting it to see it hit the higher of the highs or the highest of the highs right here. So right here, you would have hit another amazing trade with the fair value gap concept, liquidity concept, and break of structure concept. Okay? Super simple. That is liquidity. I'm going to show you guys what is also in SMT. Okay? So, in SMT, let me get my indicator out. An SMT is basically comparing the NASDAQ and the S&P. Okay? Let's take, for example, okay, so an SMT is pretty much the difference between the two, okay? So right here, if we look on the chart, we have a high right here, which is the same high and at the same time as this high right here, okay? This high right here is the same high as this high right here. Now we have these two highs. Now what an SMT is basically either one or the other takes out a high and the other one fails. Okay, what does this mean? This means that one took out liquidity and is ready to move lower, and we have another that failed and didn't have enough liquidity or movement to push it higher, which means that sellers or buyers are coming in control and vice versa. So let's take this example. This right here, we see that the S&P took out this high right here. NQ, the NASDAQ, did not, which means that we have an SMT at these two highs, right? SMT right here, SMT right here. This means that the S&P was able to take out the liquidity, NQ didn't take out the liquidity, which means sellers are already stepping in, and the NASDAQ did not have enough buyers to be able to push it up. This right here is an example of a bearish SMT because we're at the highs. There's an SMT at the highs. And as you can see, after the SMT was formed, price came back lower. Now let's take an example of another SMT that is bullish, okay? Here in this example, we have a bullish SMT, okay? This candle right here, or this low right here, lines up with this low right here. This low right here lines up with this low right here. And that creates an SMT. One, NASDAQ was able to take the low while ES was not able to take the low. So NASDAQ has all this liquidity that it has taken out along with all of these right here, while ES was not able to take it, meaning that buyers are already stepping in because buyers understand that the liquidity in NQ is already a lot and NQ is ready to make the move, which is why buyers step in early so they don't miss out on the moves. These are typically banks and institutions. So we see here this is a bullish SMT because it's two separate lows being taken on the lows. This is an SMT on the lows. SMTs at the highs are bearish, SMT at the lows are bullish. And as you can see here, once the SMT was formed, we took out liquidity, a fair value gap was formed, price came in, tapped the fair value gap. You could have entered right here on the fair value gap, stop at the low, and you could have banged all the way to where price is right now. Okay, now SMTs can fail. Please do not enter just off an SMT. An SMT is a confluence. Okay, let's take for example that there was an SMT right here. Okay, there's an SMT. Let's say price came up here and there was an SMT. Please do not enter just off the SMT because an SMT can easily be broken if the draw on liquidity is higher, right? You need to pair it with liquidity sweeps, fair value gaps, and break of structure, okay? If there is no break of structure after the SMT, that means that there's a high chance the SMT will be broken and people who use the SMT are now becoming liquidity, okay? This also happens on the 1 hour. Once again, a higher time frame has higher power. So let's take, for example, the 1 hour SMT right here. Let's say, for example, you're on the 1 hour and you see an SMT on ES and NQ right here. This SMT right here and this SMT lines up, and we see that ES took this low, NQ did not. What does that mean? We could be bullish, but we don't know that yet. So we must hop on either to the 15 or 5 minute and scroll down. We still have this 5 minute SMT. We see that price came in and we have a break of structure and change in state of delivery, right? So now that's two confluence. Now we scroll on to even lower and we see and try to find our entry. We see here, okay, price most likely wants to take out this liquidity up here. And we see here we have our change in state of delivery and we even have our fair value gap. So once we have our change in state of delivery, we want price to come back, fill the gap so that sellers and buyers have a way to go hand in hand with one another before it heads higher and takes out this liquidity right here. And that is how you can pair all the confluence that you have learned so far. I hope you guys are understanding this. It is pretty simple. It might be hard to understand at first, but this is where you go into the market and actually test out by yourself, understanding, marking out liquidities, seeing where liquidity sweeps happen, seeing where you could enter, seeing if all the other confluences line up with each other, and see why price is going higher and seeing why price is going lower. That is it for this video. Your homework is to find 3 liquidity sweeps, mark out a range with all of the buy side liquidities and sell side liquidities. And if you have any questions, the Discord is open. Feel free to type it in the question chat and someone will be there to help you. Other than that, I'll see you in the next video.